The key thing from a technical point perspective to look at with gold and silver is gold has breached critical resistance in 1900. It's trading above and has been that way for almost a week. Silver hasn't quite challenged 2450. If gold stays above 1900, I think silver can challenge 2450 and gold could drag it up.
Welcome to Gold Silver Pros.
Hey everyone, this is Rob Keens with goldsilverpros.com. This is your weekly market wrap. We're recording this on January 16th, 2023, a little bit late this week. Thank you everybody for joining. As we speak, the gold price is trading at 1950.63 at about 9:30 a.m. Central Time. It's down $1.61, about even on the day. The same for silver, trading at 24.22, down about 7 cents. Overall, not too bad. It's important here to note that the gold price has breached a critical resistance line of 1900, which was the 2011 all-time high. Certainly not the all-time high. We saw an all-time high of 2069 in 2020 during the pandemic and the shutdowns. But it's interesting to note that gold has punched through this last all-time high because it is a major support and resistance line. Now it's acting as support. We see gold trading above it. We'll see if gold holds that 1900 line this week. Silver hasn't quite followed gold through its big mark. The next big mark for silver on the charts is 2450. We're trading right now at 2422. So silver hadn't got quite as frothy as gold, but if gold stays above 1900 this week, I think we can continue to see silver challenge that key 2450 resistance level. We got some big news last week in terms of the economy. Most of the Fed members spoke, and they think that we can ease the rate at which we get to 5%, but 5% is the new target. And they also think the 5% could be the target for a while, indicating that we may be dealing with some fairly persistent inflation. And so they're going to keep interest rates up. It didn't seem as though they wanted to ease anytime soon. So I think 5% is really their target as we head into the next recession, which makes sense. That is basically the benchmark rate that most of the big guys like the BIS and IMF and the research say you need at least 5% during the next recession so you can ease into that recession. And so that's why they've got that target there. We'll see if they continue to raise over 5% and how the economy is producing. Right now, the small business index comes in at a 6-month low. It declined to a rating of 89.8 upon expectations of 92. It just means small businesses are not seeing everything be too rosy. Wholesale inventories increased by 1%. Again, we expect to see inventories continue to increase as a little bit of overhang exists with the consumers, although consumer spending was okay. Consumer sales were up 7.6%. Retail sales jumped 7.6% during critical holiday shopping season. And I said that we would take a look at that and look at the early data and see, depending on that number, it would make things seem very positive, and then the economy rebound, and we'll get to the economy rebounding here in a moment. That seems to be the case. So it was nice to see a 7.6% increase. However, playing devil's advocate here a little bit, the CPI during the same month was 7.1%. So if you net those out, we had a very modest increase in spending during this holiday season, but at least it wasn't negative, although the market's going to read it as we increased quite a bit more than we actually did. The core CPI came out last week, and it was down to 6.5%, fell from 7.1% the previous month. That matched economists' expectation. That means we're in the deflation cycle of the triple top inflation deflation before we have the big crash. We had a big inflation last year. Now we're starting to go into that deflationary pattern. We'll have another deflation pattern, and then one final if that pattern holds from the last 2 times we had big inflationary episodes. So we expect the economy to continue to deflate here for the next probably 6 or 7 months until we get our next bout of inflation. We'll keep on top of that. CPI excluding shelter was down 1.6%. So across the board, prices were falling. Initial jobless claims came in at 205,000 last week, under expectations of 210, which is very positive. So jobs seem to be holding serve, not really going either way, one direction, just sort of holding serve here, considering the fact that we've had a lot of, especially tech companies and retailers say that they're going to be laying off. It's pretty remarkable that jobs have kind of held like the half of last month. We'll continue to follow that data for you guys. The federal budget, we spent $85 billion more than we made last month. That's basically been true for a long time. But in any case, the spending is still there. We'll take a look at the markets as we're reporting this about 9:30 a.m. The Dow is up 112 points. The S&P is up 15 points. The NASDAQ is up 78 points. And the Russell's up 10 points, all up between 0.4 and 0.7%. Last week, the markets did very well. They had a nice little rebound. The stock markets did, and it wasn't too bad. Looking at crypto markets, boy, on the 14th, all the crypto markets jumped almost at the same time. Bitcoin jumped Litecoin jump, Ethereum jump. Bitcoin now is trading at 20,976, up 89.82 on the day. Ethereum is trading at 1550.92, down 0.2, which is basically even. Litecoin is down $2.22 to 86.07. XRP is trading at 38 cents. Unchanged. Overall, cryptocurrency is not doing too bad. The bond market is faring pretty well. Rates have come down since the scare we had a couple of months ago. They're still elevated, but right now the 2-year is trading at 4.224%, and that is inverted to the 10-year, which is trading at 3.498. In fact, every bond issuance shorter than 10 years has a higher interest rate, which means the market still expects there to be a lot of short-term or immediate risk. This is screaming recession. We think we're going into a recession. Now, I just told you retail sales grew, but we have earnings reports for the companies. We'll see how that goes. Remember, you have to take inflation and debt into account, and we'll see if we actually grew during the fourth quarter. But the market is still expecting a recession, and that's why you see those bond markets in yield curve inversion, where the shorter term issuances are demanding more yield because they see more risk in the short term than they do out at the 10-year, which is opposite of what we typically see. Overall, the market's not too bad. They're kind of holding serve. We're going to get into the share screen part of the program, and we're going to take you through gold and silver and what we see there. Here we have the website for the CME Group, where the data comes from the futures markets in gold. And those you following along for any length of time know that this is where the spot price is determined. You can see that here in this price here, and we'll get into the settlements here in a moment. We're looking at volume, and we had a nice spike in volume last week of gold. There's a lot of frothiness in the gold trade. Let's see what's going on there. We had 257,000 contracts. This is Friday's data right here. You can see 257,000 open interest contracts. We had 3,343 of those move from the US over to London. And that EFP trade, the exchange for physical, where people are taking their position here and they're hunting for the physical metal over in the London market, which is kind of a sister market in a way. They're loosely connected in the Western world, or they may be playing price arbitrage between the two. We've seen a lot of that lately. People are going over to London for gold exposure, which is interesting. Makes one wonder, are we a little bit short of gold stocks on COMEX, or are people just not getting the prices they want? Is there an arbitrage opportunity across the pond between their gold price and ours? And why does that exist? And why are people shifting trade over? That's a narrative I haven't really seen anybody write about. We'll dig into the data and see if we can figure something out for you guys. That was Friday's data. As we pop down to Thursday, 271,000 contracts, 2,636 EFPs overall. Interesting trade. Let's see what we settled at. And this is all out on the February contract for gold. It'll be March for silver. We'll go over that in a moment. Estimated volume on Friday's data, 263,000, trading up $22 to end the week at 1921.70. It was a good week for gold. So we go back to Thursday's data, up $20 to settle at 18.98. And you can see the trend here, up $2 on Wednesday to settle at 18.78. And then on Tuesday, it was down $1. So began the week a little bit down and then rose as the week went on. Nice solid numbers here. A nice trading volume for February. Not too bad with gold. Let's take a look at the tail of the tape in terms of the ETFs. You can see here there was, before we get the ETFs on the COMEX, there was a reduction of about 1.2 million ounces gold over the last 4 weeks. So COMEX has lost about 1.2 million ounces over the last 4 weeks. The ETFs have gained about 300,000 ounces. It looks as we net that out, 1.2 million minus 915 is about 300,000 ounces have come into the ETFs. So a little bit of gold flow back into London, as most of the ETF gold is held there. It just seems like maybe there's a little bit more positive going on in London, a little bit more flowing out of the United States. And we saw that in the EFP trades, the exchange for physicals. People are hunting over in COMEX and finding maybe more on London. That's a very interesting little dynamic we'll follow and see if that continues. Again, the overall from the COMEX has been for gold to flow out. Now we're looking at the ETF, the SPDR GLD. And you can see that that gold has been flowing out since silver squeeze, interestingly, the beginning of last year, over a year ago. It seems as though gold has been flowing out. Let's take a look at silver futures, if we will. Volume was elevated towards the end of the week in silver as well. It got frothy and to the upside. And I'm going to show you in a moment who's driving this trade. And it's not who you think it is who's driving gold and silver. It's an encouraging sign. We'll get to that in a moment. March is a dominant contract for silver. You can see here on Friday's trade data, Friday right up here, we had 110,000 contracts of 5,000 ounce silver close, and we had 282 FPs over to London. Not too bad for those numbers. If we look at Thursday, we had 109,000 open interest. Total volume on the day was 73,105. Of that, 400 EFPs for the Thursday's data, and we'll go back to Wednesday as well. On that March contract, 109,000 of open interest at close, 57,000 total settled, and EFP of 825. Let's go to the settlements and see the price action. Again, on the March contract, this is Friday's data. We load Friday right up there. You had estimated volume of 61,000 contracts. They settled up about 37 cents on the day average to 2437.2. And we go back to Thursday's data. The 74,000 contracts, very healthy, settled up 52 cents to 24,004. This is where you get the prices, ladies and gentlemen. Just go to that settlement data on the CME, and it tells you exactly where spot prices come from. That is exactly where spot prices come from. As we look at the silver chart here at Gold Charts R Us, thank you, Nick Letter, for putting this together. You can see over the last 4 weeks, we've lost a lot of silver from COMEX. It didn't matter whether it was registered or eligible. We lost it about 2.4 million ounces. About 7 million ounces have flowed out overall, so about another 5 million ounces have flowed out of the ETF complex. So despite what's happening to the price, people are taking delivery of silver off the Western markets, period, end of story. And that has been the case, especially as we see here in the iShares SLV with their silver stored in London, has been coming out since silver squeeze right there, just like the gold has. People are liquidating that silver. Does not surprise me whatsoever. What does surprise me is who is driving the prices in gold and silver. It's not who you think it is. We're down to the COT report from the CFTC. This is a commitment of traders. It's in arrears, so we've got data through January 10th, 2023. I realize that's about a week old. That's the way the CFTC rolls. We look backwards. Scrolling down to the silver report, you can see here the big change that I'm going to highlight this week. The swap dealers, after having been net long a few weeks ago, went net short about 1,000 on the last COT report, and now they're net short about 9,000 on this COT report. So they've moved, the evil empires moved back short again, if you will. The producer merchants are still short. They always will be because of price exposure, but with the price going up, they have dropped almost 3,000 of those shorts, saying, hey, price is going up. We don't need quite this short position. That protects, our downside price risk, so they've reduced some of those. That makes sense. Swap dealers dropped 1,600 longs and dropped 222 shorts. So for the week, they went net short about 1,400 contracts. The managed money added shorts and dropped some longs, but they're massively long here. And those are the ones bidding up silver, 44,900 long contracts to 21,666 short. They're more than double 2-to-1 long. They're the ones that have actually been driving this because it's as the contracts settle, which drives the price. So it's been the managed money. It's been the financial houses, which have been boosting silver and gold. We'll show you that. Other reportables in terms of they've also been boosting it. This is the family offices and the wealthy individuals. You can see that they've about a 2,000 net long side last week on silver. They're expecting it to go long. So the wealthy individuals and the financial houses all lining up long silver, the swap dealers and producer merchants lining up differently than that. Let's move down to gold. Again, as of January 10th, 2023, you can see the movement here. We always look at the swap dealers first. We consider them the sharps, or basically the house, because they have all the data and do a lot of the trading. So I describe them as the Las Vegas of the gold and silver markets. They basically set the betting line, if you will, for us. And they had added 5,400 shorts in gold and dropped 2,200 longs. So a net of almost 8,000 shorts. So they're really jumping on the short bandwagon on gold as well. The managed money, you can see, took an additional 7,400 longs and only took 236 shorts, or about 7,000 additional long contracts. They took almost all of the 8,000 on the other side, the swap dealers, in the last week. And so they're now long 116,000 contracts to 54. Again, a little over 2-to-1 managed money long on gold and silver. And you see the same thing happen with the other reportables, the family offices. They're up almost 4-to-1, 126,962 long contracts to 38,000 on the short. But they added a net of about 1,700 contracts alongside here if you net out those two numbers. Overall, a lot of interest in both gold and silver, and I believe that market has gotten quite frothy, ladies and gentlemen. And I think the big story really has to do with what is going on with the stock markets. They're ebullient. Retail sales appear to jump, even though if you net it out with inflation, it's not much of a move at all. It's kind of keeping our head slightly above water, if you will. And I think the markets are ebullient to the fact that we didn't have a complete and utter crash everywhere in the economy. The fourth quarter came in at least even in terms of retail sales. We're starting to get those earnings reports this week. A lot of the tech companies are coming out. We'll see over the next couple of 3 weeks, through the end of January, and so how that happens. For those companies that end calendar year 12/31, it may take them a little bit longer to get their reports out because they're doing their year-end accounting, stuff like Sarbanes-Oxley and compliance. And so we may see some of those earnings reports come out a little bit later, but certainly the next couple of weeks will tell us how the rest of the economy outside retail, we know that did okay, outside retail, how that did in the fourth quarter. And that'll give us a good idea of how people are feeling. We think we could have a little bit of a head fake in the stock markets, and it continues to march up. Looks like the cryptos are marching up in lockstep with the gold and the silver. If fear is off, that means gold and silver could retrace a little bit, even though it's been up early. And again, I think the gold and silver popped about a month earlier than I expected. I think it popped on worries about what happened last year, but we really have to see what happens with the earnings reports that are coming out for fourth quarter and year end, and the data for year end on how companies did year end and how consumer sales continue to come out from last quarter. If those continue to be rosy, it could actually put downward pressure on the precious metals as the stock markets and Bitcoin, things like that, rise. However, if some of those earnings reports come out and they're not so rosy, and then economists begin to rationale like I am, we had a 7.6% pop in sales, but you also had inflation. Maybe that wasn't quite so good. You know, we may start retracing backward in the economy again. Maybe this pop in the stock market we had last week kind of comes back down and gold, silver begin to rise. The key thing from a technical point perspective to look at with gold and silver is gold has breached critical resistance in 1900. It's trading above and has been that way for almost a week. Silver hasn't quite challenged 2450. If gold stays above 1900, I think silver can challenge 2450 and gold could drag it up. And gold will continue to drag silver up quite a bit until we have an event which warrants much, much higher prices. I think that's really the story here, but I'm still interested to see some of that economic data before I call the fact that the markets have come back. Whether we're talking about the gold markets or the rest of the market, I think there's still more to see there, and we'll continue to cover this in these weekly market updates for you guys that we do every single week. Thanks for staying tuned to the channel. We will have more. Until next time, this is Rob Keens for Gold Silver Pros.
Searching for the best precious metals deal? Shop with our trusted partner, Arc Silver. Access special deals on silver, gold, and platinum through our website, or call 307-264-9441.
Hey everybody, we're back with Ian Everard of Arc Silver to do our weekly metals update. And Ian, I thought it was kind of disturbing when you reached out to me this week because you're mentioning potentially the institution of capital controls, or maybe formally or informally, where people aren't being able to get access to their money, which would be a big problem, of course, when we're headed into a great reset. Tell us what you're seeing out there. What's going on?
Yeah, we spoke last week about how I see a reset into digital could actually work as long as they trap a lot of currency as old dollars and start again with a new digital dollar. And then I saw an article by Michael Oliver, American Capital, and towards the end of that, he talks about Blackstone and BlackRock's property funds, how they've frozen withdrawals. So people have got billions of dollars in those funds, and it's showing as dollars. It's showing, I think, on the BlackRock US one, up 15% on the year, but they have no access to it. So it seems like, whoa, it's actually happening. There's dollars that people think they have that they can't even access at the moment.
Why aren't they able to access them? I don't get what's going on.
So the property funds, they have built into them a limit on the amount of withdrawals, because if they have to dispose of a huge amount of property, it's illiquid in a very short term. And I think also they probably must have sensed that the market is turning down and they really don't want to have to do a fire sale. But the time will come up when the 3-month period comes up, there'll be another mass exodus to draw dollars out. And at some point, it could be that the money actually isn't in the fund anymore.
And which fund is this again?
In the BlackRock US housing, and I think they have one in the UK.
So they're limiting customer withdrawals from that fund?
Yeah. Well, they're frozen. So,
but shouldn't you be? I mean, isn't it in their prospectus or whatever that you should be able to access your money because it's a fund, right? So you're not investing in the real estate to take title per se, where it's a traditional real estate transaction. You own it, and then you got to put it on the market with an agent or for sale by owner. You're saying it's a fund. People put money in the fund. They invest in various real estate securities, but there's some sort of liquidity event going on where they're not even allowing people to take their money back out of that fund, right?
Yeah, I mean, at the end of the day, it isn't any difference to FTX. When
Exactly.
people started to withdraw, they stopped withdrawals when they actually physically ran out of dollars. So yeah, I'm sure in the prospectus they got a clause saying they can put a stop on withdrawals if there's a surge, just by the nature of holding property. But at what point do those dollars actually cease to exist? Do they just disappear? If their fund value falls, are they going to cross-subsidize it? Are the owners of BlackRock going to put their own money in to make people whole? I'm sure the small print says it's your risk.
Well, again, okay, so this is very interesting. So BlackRock's investing in a fixed asset, but the vehicle in which they're taking funds from is really a little bit more liquid. They're investing in long-term investment, but they're attracting capital as a short-term investment. And the short-term investors, because they don't have the restrictions on the physical capital itself in terms of ownership and turning it over, they're just saying, give me my money out. BlackRock in that case would be taking a loss on its portfolio, right? Because they would have to at some point, either like you said, support the fund by doing capital injection just to support the withdrawals, or sell the underlying asset, the property. The problem is property market is down, prices have come down, velocities come down. There aren't enough buyers at these current interest rates. So wouldn't that essentially be forcing BlackRock to take losses or potentially become insolvent as a fund?
Yeah, or just I'm sure the clauses say it's your risk. If you get to the last few pages of the small print, that nobody ever does, that your capital is at risk. And I think just by the nature of fiat currency, if you hold fiat currency, your capital is at risk if you count capital as the right to buy something in the future at a certain time that you choose in the future. So the whole fiat system is a pretense, really, at current valuations of real goods and services. So you either, to reconcile the overcreation, we've either got to have a rapid further increase in the cost of goods and services, or a destruction of the amount of capital chasing them. And yeah.
So isn't this going to be an issue going forward with a lot of these funds that are collecting money and putting them into longer term assets? And if people say, I need access to my cash, potential to bankrupt, it's kind of like, think about a bank run, for example. You go to the bank, they don't have the cash, they shut it down. And if they shut it down, that bank become insolvent, it could affect their charter and their ability to operate as a bank. How, if a fund basically shuts down and says, yeah, you can't have your funds back, does the SEC or something step in? Or like, I'm really curious as to what would happen. You know about the banking rules. What happens when these funds don't have the liquidity? They're in longer term assets and they don't want to sell those assets. They're underwater, or there's not a liquid market for it. But again, they're taking money in from people thinking this is a liquid investment. This entire investment complex, any investment which has that format where the investors getting in can get out really quickly, but the assets themselves can't be disposed of in an environment where the asset values have come down. That seems to me like there's probably going to be some bankruptcies coming in a lot of traditionally used funds, any sort of fund in any asset where the investors want the money out, but you can't sell that asset really quickly at what you paid for it. You're going to take losses one way or the other, I would assume. Wouldn't this spread to the rest of the economy potentially?
Well, not potentially, definitely. I mean, if people can't withdraw their dollars and they need to, they're going to be in a position where they might not be able to pay something else they need to pay. So you get a contagion can move very fast, for sure. Yeah,
I would think that this would spur on what you were talking about last week, which is the reset, because let's say you have massive issues of this where they're having to, maybe this is the catalyst, Ian. Maybe it gets so bad in the economy, maybe not right now, but give it 6 months, a year, whatever. It gets so bad in the economy, everybody's wanting to liquidate, everything freezes, the bank system, a lot of these funds. Maybe that's what forces them into the reset to say, well, either we crash the entire system or we hit the reset. And the stranded dollars you're talking about could be on a lot of these existing products that people are in. That's where your dollars could get stranded or devalued, maybe 30, 40, 50 cents on the dollar. Is that what you see happening?
Yeah, I mean, I think it's more of a presumption. I'm making the assumption they want to go fully digital. One, it gives you control, and two, it's a way of carrying on a fiat system for maybe a decade or two decades more. So yes, just people wanting to make withdrawals and take money out of money market funds or whatever, stocks, bonds. I would have thought only a 5 or 10% withdrawals would collapse the whole system, because that would start forced fire sales, which would crash the value of those assets that the funds would have to liquidate. So yeah, the actual dollars have never really been there in the funds in the first place, because by the time they take out their fees and then the money's passed on to a third party and fourth parties, there's a lot of people feeding off these funds.
Yeah.
So I doubt if there ever was 100% available, even on day one.
It's almost like rent seeking, because you get these funds set up, people get their fees off of it. It's mailbox money for those guys, and those guys will all go out of business. You know, it's like getting a rent check. In a way, they're getting all these fees off the business for basically being a conduit. Most people work in financial services or a conduit into funds. And this is a secret people don't know. I worked in financial services. It's not as though people in financial services are trying to custom design you a portfolio and all this. There are those that do it, but overwhelming majority of people in financial services get their business partners first, and then they try to force people into those investments. And I've seen that even at big banks, where we went years ago to transfer an account my ex-wife had from her job into another qualified account. She was going to work for herself. So she had to move it within a certain period of time. And the bank put her into something she didn't ask for. She asked for X and they put her into Y. And she said, this is what I wanted. She said, well, we don't have that. She said, why did you not tell me that when I came to you? And they said, well, we thought this would be better for you. And so they're pushing products, and they're pushing money into products that make them more money. And it happened to be a product that was like a Goldman Sachs CD type of deal, where Goldman Sachs would get that money, pay her very little, less than 1%. And they would go invest in very high risk type of securities, including junk debt, real estate, other stuff like that. So it's exactly what you're talking about. So it's not only that people are putting money into what they think are liquid, safe investments, but a lot of times their brokers aren't putting them into what they want. They're putting them into, they're pushing money in certain places. And that's going to come back to roost, because you're going to have a bunch of money tied up in these funds that don't do well. And I think it's probably going to put some of these banks and brokerage houses out of business, and probably bankrupt a lot of people that have invested in them as well. And the only way to get around that is to have something, you know, physical in your hand that you can touch. And again, another case for the precious metals outside the system.
Yeah, no, I fundamentally agree with that, Rob, because not only a lot of these assets we're talking about not performing well and they're losing dollar denominated value, all of the fees and commissions are extracting value as well. And you can bet your life that money's been spent, that currency has been spent. Those agents have bought cars, houses, holidays, real things.
Well, I mean, that's what pays for infrastructure for them to advertise it. So when you're buying a fund, you're buying the infrastructure from advertising. And of course, when you're buying gold, you're also paying for infrastructure. But at least that gold and silver holds value over time. And we saw it in 2022. Everything else is crashing down, even real estate at the end of the year. It finally gave up. At the end of the last quarter of the year, real estate started crashing. It gave up the fight. Gold and silver in the year up slightly up, and now they're running. Let's see what gold and silver is up to right now. I'm looking at goldprice.org as we record this on Sunday, and gold's 19.23.19, silver's at 24.27. 24.50 is a really key resistance point at silver. That's why it's been trading that way over the last week. It hadn't punched through 24.50, but when it does, I could see another run going up to 30. Ian, we're already at 19.23 gold, so we're $1,040 under the all-time price. We're not that far. What's your view on gold and silver? They're running quite a bit to start the year, and we haven't even gotten the good or bad news on the fourth quarter and what the consumer did, and whether or not the Fed's going to continue tightening this year. I mean, it surprised me. I thought it was going to occur a month later. I thought in mid-February we would have earnings reports, we would have consumer data, the Fed would use that to act on what they're going to do with interest rates, and I thought we'd get our gold and silver run maybe mid-February. It's already started. Why do you think that's the case? Well,
there's a lot of people buy the precious metals. Turkey, Venezuela, Egypt, the population have been desperately trying to get out of their currency. I think it was in Venezuela, they just announced 93% official inflation. I mean, I was looking at the gold charts in pounds, and in 1980, 1.5 of these £10 notes bought an ounce of gold.
Mm-hmm.
Now it needs nearly 160 of these. So it's a factor of about 108 in that time period in pounds. And if you look at the long-term metal charts, they are exponential. Mm-hmm. So if we're correct, we're entering that near vertical change in how the precious metals are priced in fiat currency.
Go ahead.
Yeah. No, so it's frustrating. It's frustrating for people who've bought higher than it is now, and it's frustrating for people who've been buying at 18, 19, and now they're looking at 24, 24 and a half without the premium on silver. And I think there's inertia. People are waiting for a dramatic pullback, and that may or may not come. Personally, that's a gamble I'm not going to take. I'll just keep buying every opportunity.
You know, something I was looking at in something that's on the video prior to this segment, when I do my market wrap up, I look at the CFTC COT report. And as I'm looking at the latest numbers as of January 10th, the bullion banks have gone net short silver by a lot. Last time I looked at it, it's 1,000 contracts. Now it's almost 10,000. They're short 45,649 silver contracts and long 36,462. So it appears as though they're trying to bring the price back down. Same thing in gold. They added 5,400 short contracts in gold and dumped 2,200. So they moved net short almost 7,700 contracts in gold. The banks are shorting gold and silver, maybe to try to keep that price contained, or maybe they think it's going to come back down. That's obviously not working. Gold and silver's running. So gold and silver's running despite the actions of the bullion banks, which are the biggest single player group of 4 and 8 players on the exchange. We know this because that's reported data from CFTC and also Office of the Comptroller of the Currency. So we know who those banks are. They're shorting massively, but the rest of the market seems to be going long. I think it's, Ian, do you think they've lost control? Because it seems like to me, I mean, the managed money has gone massively long silver. I think they must be watching our program because they're almost always, on the wrong side of the trade. They're on the right side of the trade. Managed money is making money on silver. And if you look at managed money on gold, they're double up on their longs to their shorts. So the financial sector, those guys, we have to give credit to them. They're the ones pushing the prices forward. It's not the bullion banks. It's not the family offices. It is the hedge funds and those types. They're driving it forward, and it looks like they're pushing it so hard that the bullion banks can't keep it down. I wonder if this is the market finally saying, we see risk. 2023, we're going long gold, silver, no matter what the hell you say.
Yeah, and that's what we do when we buy physical. I mean, $30 definitely seems to be key with Smackdown, Rostin Benin saying he saved the financial world by smacking silver down, even though he has no business directing the price action of any commodity. He's supposed to be just checking the rules are being followed, which they're not. Hence, they wouldn't be able to be doing, was it 5,000 contracts is the limit on silver, and that's frequently ignored.
Yes.
So you would have to think that these bullion banks, the big banks, are acting in collusion. There's somebody directing them. We have to slow this down. We've got to slow down the price move.
What's just unusual is even though that they've come in pretty hard because they had flipped long silver ending the year. Then when silver started running, they went short, and then they went short again, 2 consecutive weeks, and they're just dumping contracts. It's going to slow down silver's progress. That's why silver kind of, flatlined this week. But Ian, what I'm seeing in the market is the rest of the market's woken up. And I think this run this time, I don't know if they're going to be able to stop it, because if you have managed funds starting to come in into this sector, the banks cannot stop them. The banks, they have the wherewithal to do it. They could dump a bunch of paper, but there are more financial houses than there are the banks. And I think what's happening is it's the few, trying to hold the price in a range, and the many saying, we're running. And it's when the many get together that you're going to see a breaking in this market. And that sure as hell looks like it's what I'm saying right now. It looks like the many are saying, forget this, we're going long. I don't think the bullion banks are going to be able to stop it this time. We'll have to look. I mean, but they're really going to have to dump a lot of paper on this market to stop it. So it doesn't look like this time. I don't know. We're going to see.
Yeah, and I think the public are a lot more educated. I mean, I don't know how many precious metals channels there are on YouTube now, but there's a lot more than there was 2, 3, 4,
Oh yeah.
5 years ago. And a lot of them, like yours, are growing. They're building interest. You've got people who are really much more aware of the lie of fiat currency. So, and with silver being such a tiny market, and we've said this, yeah, I know we've said it many, many times, but 1/10 of an ounce per person on the planet is mined per year. It's 1/10 of 1 ounce. It doesn't take a huge amount of people to make modest positioning into silver, and it's gone. And then if there is no physical, that you can't have a future contract, which is a derivative of a derivative on an item if the item doesn't exist anymore, if it's gone. And then you add the industrial uses and the medical uses and the military uses and the space uses for silver. It's the essential element, and those aren't going to go away unless we jump back 100 years, go back to early industrialization, which, whoa, I guess that could happen. But then if that happens, we're going to be using silver as money. We're going to need every physical piece of silver if we go back so backwards that we haven't got computers and new technology.
So silver's going to have value in whatever society, no matter what. I think it's and gold will always is money, but silver, having that dual nature of it, I think is always going to be a certain amount in demand. And to that point, we want to talk physical. So Ian, I think you may have some special deals for us this week for Gold Silver Pro subscribers only. So talk to us about what you do have.
Yeah, sure. So it's first come, first served, and that's new clients and existing clients. So we have a 100-ounce Johnson Matthey bar.
Oh, beautiful. At
spot for the first lucky person who gets hold of me. And the best way is to call me if you want to be really quick. Then we have some pre-33 gold. We have a few of these at spot. The premium on these is around 200 retail if you look on any of the big sites. Yeah. So we've got a few of those. We've got a 1-ounce gold maple at spot. And we've got some different bars, 5-ounce, 10-ounce, 100-ounce kilos at spot. We have some Britannia bars. I think one of Rob's favorite at spot. So you won't get these deals anywhere. There is zero channel. You might get giveaways where only 1 in 1,000 or 1 in 10,000 people can win. But on Gold Silver Pros, you get gold and silver at spot.
At spot. And all you have to do is go to goldsilverpros.com, click on the link for ARC Silver, fill out a real quick form with like 4 fields in it, and we'll either text or email you back in. Tell people about the type of service that you offer in terms of if they come to you and say, I want 100, silver ounces, how do you go about getting that to them? How does your service work?
Sure. Yeah. We just want to find out what the people's objectives are, have a discussion as long as they want. What have they got existing? How do they want to improve their portfolio of metals, give them more flexibility? We want to do our best to make sure people are buying the right product and at the lowest premium that we can find in the market.
So what you're doing essentially is you're custom designing strategies for people depending on where they are and where they want to go.
Yeah.
And you'll work with people if they have an existing portfolio, or if they don't, you'll work with them to understand what they need and design a portfolio that works for them, right?
That's what we try to do. Yeah.
And what's the minimum order, Ian? Are there minimum orders for you? Do you work with people at all levels?
There's no minimum orders. We have 5th ounce rounds. You can buy 1 more nickel if you want. And 20 of these as a 1 1/8 ounce of silver. So there's no minimum. And if you want to do a mixed order, we'll do a mixed order at the maximum discount rate. We virtually have almost eliminated the scale of premiums. So if you buy 1 ounce, it's very similar. If you buy 20 or 25, which is very similar. If you buy, we've closed down, we've brought the discounting down the quantity range just to help the person who's on a small budget or is dipping their toe in the water or wants to put a little bit of their rainy day fund into silver. We don't want premiums to be a barrier to that. We're working hard to make it easy in, easy out as well.
And we get a lot of emails in all the time from people, multiple wins a week, asking to set up a savings plan. Like they want to invest so much a month. Can people do that with you if they say, I just have $500 a month or $1,000 a month? Do you work with them on that as well?
Yeah, we can set that up, and for sure. We do that for a few people already. And if they want to amalgamate orders to make it more efficient on the shipping, we can do that. Yeah.
Ian, do you realize what you just done? You came on my program and offered all this metal at spot. We're going to clean you out because nobody can get this deal anywhere else.
No, it's limited, and depends how polite you are on the phone to me. If you call me up, I might extend it. If I've sold out, I might have a dig round, see what I can do. But yeah.
Everybody be nice to Ian so you can get your metal at spot. That's a fantastic offer. And I know if you went to any online dealer, you're not going to get that deal right now.
Yeah.
All right. Any last thoughts from you, Ian, before we wrap up today?
Yeah, I just want to restate, America is an absolutely great country. This is a great nation. We have great resources. We have great people. Government is a bit lacking, I would say, in skills and talent and direction, but the people are great. This is a great nation. We are going to prosper, but we have a choice. If you want to prosper more, get yourself some precious metals, get yourself some financial insurance. Even if you only have 1 or 2% of your portfolio, the downside is zero and the upside is multiple gains in purchasing power.
Yep. Thank you, Ian, so much. We'll see you next week.
Thank you, Rob.
Hey, thanks for watching. We selected these videos just for you. Check them out. And remember, $4.99 a month keeps the lights on and the channel going. So join our Gold Silver Pro supporter membership. We appreciate your support. Keep stacking.